TheoTrade. This is Don Kaufman. It's March 15th, 2019, and you are watching the TheoTrade Weekend Update. Well, we're kind of dubbing this weekend's update, Risk Assets Have Gone Awry. And I'm going to spend the better portion of this video talking specifically about, well, what does that effectively mean? Let's begin with kind of a quick update on the marketplace this past week. For those of you that do tune in on a week-to-week basis, I talk extensively about what is termed expected move. That's how the option market kind of depicts risk on a week-to-week basis. Anyway, long story short on this front, this is now the second week in a row that we've absolutely smashed through the expected move. You got to realize the SPX this week of trade, we started trading at 27.40. We ended the week where? Okay, 28.22. We're seeing again an $80 move. What was expected? What the option market, again, kind of expected us to move? Well, we were looking for about a $44 move. So once again, we're at about a 2 standard deviation move against what the option market, as I said, kind of depicted risk, which that kind of kicks off, you know, this theme of like risk assets have gone awry. You have to realize the implications of what we're saying with expected move. The entire options marketplace in the SPX, which has literally tens of billions of dollars at risk on an expiration by expiration basis, has now gotten the options market hideously wrong for the second week in a row. And again, I'll come back to that a little bit more when we start to get into some of the charts, and I'll show you kind of visually what that looks like. Now, let's dig a little bit more into this theme. As I said, kind of risk assets have gone awry, and we're going to start that discussion with utilities. Now, I had mentioned this kind of briefly in a video earlier in the week. You know, have you looked at utilities? And specifically, let's talk about the utilities ETF, or the XLU. And I'm just going to kind of boil this down. So the XLU, it's utilities, which is not exactly the most exciting thing. It's not, you know, a blistering, you know, index that you're like, oh, I got to get involved in this. Nevertheless, it's up 12% on a year-to-date basis. It's right pretty much at par with where the S&P 500 happens to be. That doesn't necessarily bother me. What kind of bothers me is the fact that it's up 12%. It has a 0.24 beta, which means beta is the relative movement of a product versus the S&Ps. So this product is supposed to move what? Really, really slow versus the S&Ps. Here it is pretty much at par with the S&Ps. Okay. The other issue that I have here is this is predominantly thought of as a defensive sector, but it only pays right now about a 2.96% dividend. So I can't even make a great argument for buying the XLU from the dividend perspective, because if you look at like a 6-month, you know, treasury right now, a 6-month treasury is trading for 2.5%. Does it make sense to go out and to risk capital in a utility at a mere what? You know, less than 3%. And again, you're going to see in just a moment what that kind of boils down to when you look at the XLU versus some other products on the screen. When I talk about like risk, you know, assets going awry, it doesn't make a tremendous amount of sense to go out there unless the marketplace is already, kind of foretelling you something that interest rates are about to go down drastically. And that's one of the things that we have to think about when we see something like utilities continually rallying. I mean, you even look at utilities, which we will hear momentarily, on a 10-year chart, and it's absolutely astounding. But it's not just about utilities. There are a ton of these products, and we talk about like risk on and risk off, you know, going out there and should we be buying equities or should we be buying something that's defensive? Well, the irony is in this particular case, they're buying everything. They're absolutely buying everything. I think the other big standout happens to be like Reits, real estate investment trusts. And with some, to get specific, and I'll use an ETF in this case, we're going to look at the XLRE, which happens to be the real estate sector. It's up 17% on a year-to-date basis with a nominal dividend, 2.3% dividend over there. Again, what's the argument to go out and to purchase a REIT right now? And again, a lot of these REITs happen to have nothing more than commercial property, which is being left aside by the entire retail world, right? So retailers are closing down kind of left and right, and yet we have real estate investment trusts, and they're piling into it like they're going out of style. Everywhere we look, risk assets, okay, are screaming that interest rates apparently are going to be going now effectively to nothing once again. And how does that bode well for the marketplace? Okay, net, what I'm also going to show you here momentarily is what this kind of boils down to, okay, is that there are some wonderful opportunities, okay? Eventually this marketplace is going to make a lot more sense than it does right now, and that's what we're going to explain to you here momentarily. With that, let's get a little bit into the charts. Let's spend some time looking at some of these specific products, and I'm really going to try to delineate precisely why I'm saying just that. Risk assets gone wild. To the charts and trades we go. We're going to start this portion of the video here at the U.S. Department of Treasury's site. Oh, it's an exciting site. But what we're actually trying to delineate to you is a little bit about not only the yield curve, okay, but basically what some of the rates are at. You know, just a moment ago, I was actually talking about the 6-month treasuries, and I'm just highlighting right here. This happens to be the 6-month treasury. Here is today's trade date. You'll take a look at the 6-month. It's 2.5%. Well, why do I care? Well, first of all, it's 2.5%, and yet what we're going to show here in a moment is a little discussion, of course, of the XLU, the XLRE, okay, but take a look at the 6-month. That's 2.5%. Has now eclipsed effectively the 7-year, and really is within a stone's throw of the 10-year. So what do we have? Once again, I've been pointing this out kind of week in and week out. It's an inversion of the yield curve. Now, is that really intimidating anybody away from the markets? Absolutely not. That's one of our first kind of big risk assets. I mean, listen. The yield curve itself is screaming, we got issues, people. But again, I think at this point, the marketplace is kind of pricing in. Don't you worry about a thing. And that's, you know, one of the issues, of course, in play right now. So with that, I'm going to cruise over now back to the trading application. We're going to go to the XLU, and this is what I was mentioning. To begin with, in the XLU, you know, all right, the chart is quite spellbinding, but let's cruise over here to the year-to-date percentage. Now, on the year-to-date percentage, as I said, it's up right around 12% year-to-date. I will cruise over to the trade tab here, open up, and you're looking at what amounts to a 5-year beta. So you just saw a 12% move to the upside, okay, but on a 5-year beta, you're looking at about 0.24. So it's alarming. It's alarming because you have, again, kind of these risk on, risk off assets. The bottom line with the XLU, it's not supposed to be moving, okay, at a similar rate, if you will, to the S&Ps. Its volatility is also elevated, okay, and it remains in an elevated stance for quite some time. By the way, with this, again, we come down to a 2.9, okay, div. Now, the dividend, the yield associated with this, the problem that I have at this point in time with that dividend is you can't make an argument like, why are they out here buying this? And you know what? I am looking for explanations. Why do you want to buy, okay, utilities that are paying less than a 3% yield in this kind of an ascension? I mean, this is a product that's not supposed to move. First of all, that's moving massively, right? Way over its skis in terms of risk. And yet at the same time, nobody's talking about the fact that it just continues to explode to the upside. Now, I'm not necessarily making a bullish or bearish case for this, okay? I'm simply making the case of, obviously, you have got all kinds of funds that are currently purchasing utilities like they're going out of style with a 3% yield, okay? And they're buying these utilities, okay, at their, you know, basically their all-time highs. I just pulled up like a 10-year weekly, but they're buying them at their all-time highs. How, okay, does that make sense? You know, you talk about like risk on, risk off. This is typically thought of as a very defensive sector. Where do you go, you know, when you're nervous? Well, I go into utilities. Where else do I go when I'm nervous? Okay, well, obviously I can go into the bond market. I can pull up the TLT, and I'll stay away from standardized, you know, bond futures. I could pull up the TLT. Obviously the TLT, okay, it hasn't backed off an inch, but I've made that argument before. But let's now go take a quick glance at maybe a sector that you're not necessarily familiar with. Again, that's the XLRE. It's the real estate, okay, spiders. It's basically invested in a whole bunch of REITs. And here's one, I was talking about an astounding move in the utilities. This is up 17%, okay, 17%, which is crushing even the Nasdaq. All right, so a little bit of a compare and contrast for just a moment, if you will. We can actually pull up studies, go down to add study, compare with. All right, we'll throw in a custom symbol. Why not? Let's just throw in the QQQ. Hit enter on top of the QQQ. All right, we're going to go back to studies. We're going to go add study. Okay, compare with custom symbol and type in the SPY. Okay, and what do you got when you have all three of them here? All right, so just to kind of, again, make sure everybody's on the same page of what exactly we are looking at. This happens to be, real estate kind of sector. Right here is the QQQ, which is your Nasdaq, and down below over here is the spiders. Right? If you wanted, I could even throw utilities in there because utilities would fall, okay, right in here with the spiders. And think about that for a second. So we have, again, what is generally thought of as a defensive sector in real estate, outperforming the Nasdaq and outperforming the S&Ps, and yet right there, again, right there with the utilities as well. Okay. Again, how do you make an argument for this when it has a 2.3% dividend, and yet, again, asset managers are out there buying it like it's going out of style? So you have to kind of ask the question, when I'm talking about buying it when it's going out of style here, this is one that actually kicked off. I opened up a chart here, kicked off in 2015 was the initiation of, again, this real estate sector. It's effectively also at its all-time high. So how do you make an argument right now to want to go out and buy the real estate sector? How do you make an argument to want to go out there and to buy, of course, the utilities? Clearly, these asset managers, okay, are either throwing caution to the wind, okay, or they're doing the exact opposite. They're being incredibly defensive at this point in time. And I would believe it was the latter of those two, that they are being incredibly defensive. So you have a couple of trade opportunities even in, okay, these two asset classes. If you looked at the XLU and thought to yourself, well, that is absolutely ridiculous, we could just step in and short this, okay, could be the great short of all time, right? Maybe the market is right. Maybe the market just keeps exploding back to the upside. And you know what? Eventually asset managers in here just say, that's it, we're done. Okay. Or they're spot on. Okay. Or they're spot on here in XLU, and interest rates are about to go back to effectively zero. Okay. And they're dumping capital into utilities early on. Okay. To be first in line to receive, again, that 3%. But that's, we're not just going to stop with looking at, real estate sector. We're not just going to stop with looking at like the utilities. Where else? When we talk about like, risk assets, a lot of people don't necessarily categorize risk assets. Look at the SPX, okay? The SPX, and I talk about like markets are getting absolutely nuts out there. The last 2 weeks in a row, we absolutely smashed through the expected moves. And you have to realize, again, the gravity of the situation of smashing through the expected move. Again, I want to kind of highlight this for just a moment. This is the previous week's trade, all right? That was us closing to the outside and to the downside of the expected move. And this amounted to almost a 2 sigma move. And then, of course, this week we kind of smashed the upside of it. And it's just about a 2 sigma move. So 2 weeks in a row, we get pricing of the options wrong. If you sold anything this week, dead. You sold anything this week, dead. We smashed outside of it, right? Hedging activity drove us, which I have to tell you, from a probability standpoint, the probability of this occurring, okay, twice in a row is alarming, to say the least. But here's the craziest thing. The craziest portion of this, and again, this all fits right into this key, theme of just risk assets. It's just all kinds of wrong. Take a look at this next week of trade. Now, I say the next week of trade, the coming week. And I'm going to actually take you specifically into this. We're just 7 days out from the next Friday expiration. Take a look at the implied volatility. They've actually taken the implied volatility down. The week before, we at least had about a $44 expected move. This week, or should I say this coming week, we'll have a $33 expected move. So what gives? You see us, okay? You see us crush through the bottom of the expected move, right? Then you see us crush through the top of the expected move. You get it wrong twice. Okay, what is it? The third time is going to be the charm. They actually took the implied volatility down, and we've just cracked through the expected move. Again, 2 out of the last, 2 weeks. And again, you even have another breach of expected move over here. It's displaying right now, okay, some wild, if you will, almost inefficiencies in the marketplace. The other thing that really kind of resonated, this was an expiration week, and yet there was just not a lot of volume. There was like no liquidity out there. In fact, for that, I'm going to cruise over to the S&P futures. And inside of the S&P futures, when I say there's no liquidity, this is the triple witching. Some people call it quadruple witching. You're never going to get me to say quadruple witching because there's not really any stock, futures out there. Nevertheless, we did 1.3 million contracts in the S&P futures, okay, on an expiration, okay? And it's beyond light out there. Okay, that's in terms of volume. So not only are we smashing through, again, expected moves, we're doing a terrible job of the markets actually pricing options. I mean, you think about I talk about efficiency and inefficiency of this, okay? You could have bought options the last 2 weeks, just outright bought a straddle, a strangle, and you made money on them. That doesn't necessarily say that you're going to make money this next week. Okay. However, I'm going to tell you right now, and I'll scream it to you, and I've been screaming it the last couple of weeks, you don't sell options right now. You can't. Okay. The actual move in markets, is still well beyond what is being implied by the options markets. The option markets, again, they're doing a terrible job of pricing the forward future of risk, which actually brings me to one of the kind of the key points and one of the key trades. Now, the stuff right now that you have to look at, okay, in this marketplace for trade opportunities is going to be, categorically speaking, and I've been talking a lot about this, the stuff that I'm going to be doing is, categorically speaking, lower, okay, probability trades. And a lot of people don't like that, he's going to be doing lower probability trades. Why would I want to do that? First of all, high probability trades are predominantly selling option premium. We're going to take lower probability shots, okay? But when you take a lower probability shot, what we call, all right, the payout function is going to be extraordinarily high, which means it's a lower probability. So let's say that we're going to be doing a trade, okay, with a probability of only 20% of that particular trade working. So you're going to be striking out quite often. But when it pays out, it's going to pay out absolutely massive. We're going to look at positions, okay? They're going to be long volatility, okay? Why long volatility? Long volatility in a marketplace that's got lower volatility at this point in time. But that's only, again, we know we can go up and we can load up at all the VIX that you want, buy your VIX now. Okay, but the VIX doesn't necessarily have to go bursting to the upside. So long volatility is only one, okay, I think, minor nuance of this. Some of the other types of trades that we're going to be doing, okay, are going to be things like Rts spreads, okay? RTS, was that thick enough there? The Rts spreads here, those are risk twist spreads. Risk twist spreads, okay, are going to be these long shot out of the money trades inside of the S&P to try to take advantage not only of an explosion of volatility, but the possibility, okay, that risk assets here are wrong. Okay, it doesn't necessarily have to be done in the SPX. We can use RTS spreads. You might look at this picture here and disagree with me. You might think like, nah, listen, this marketplace is going to be just fine, right? Maybe you want to look at like a risk twist spread and something like the bond product itself. You think bonds are going to come back down? Okay, risk twist spread can pay off, but it's a lower probability trade. Right now, what I'm saying is you're going to have to, with these low probability stance, you're going to have to kind of weather a bit of a storm. And again, that's not a comfortable place for most people. Got to weather a storm. What's the storm? Well, right now, we're flooding capital into, again, pretty much everything that's not nailed down. I mean, look at this today. The S&Ps are up, what, 1775, right? Great. Bonds, yeah, they're up. They're up almost a full point. So you got what? S&Ps up, bonds up, okay? Dogs and cats living together, gold up. Okay, it doesn't matter who you are, where you are. What do you do today? You just plain buy it. Now, somebody's going to flinch. Somebody's going to be wrong. Okay, what I'm actually looking at myself, okay, I actually think it's the equity markets. I mean, now all the news that continues to come out is rather negative. Now, this is my own take, is going to be a bearish tilt on the overall markets, right? And I have been for a long time. Paid off extraordinary in 2018. 2019 started off with a bang once again to the upside, and this has been absolutely relentless, okay? What do? We come over here, we use these lower probability strategies, all right, and we wait for that payout function to eventually do just that and to pay us, okay? So in this particular case, I'm going to be using RTS spreads and things in, okay, major index products. I'm going to be using them in other products, okay, that have exploded to the upside. All the meanwhile, the equity market also presents some wonderful opportunities. One of the things I've been looking at in the equity markets, in fact, I'll give you this week at large, is, Boeing. I have to say that Boeing, it saved my entire week. Even though the S&P's exploded to the upside, I happen to have bearish positions on. Okay, the down move inside of Boeing saved the entire week. The positions in Boeing, although they're not exactly massive, okay, were more than enough to offset any of the upside movement inside of the S&Ps. Unfortunately, a major aircraft being grounded, it's not exactly the way you want to save your week, but we'll take the defense gives you. Okay, so the other kind of key point that I'll make with this, and it takes some time to play out, are going to be what we term duration positions. Now, what are duration positions? And I'll give you an example of a duration position. Okay, here's Costco. So I am not currently inside of a Costco position. Nevertheless, I am kind of stalking it after its most recent earnings announcement. Stock's absolutely exploded to the upside. What a duration position amounts to, it's taking, okay, a long or short position. Now, in this particular case, okay, obviously, again, I'm looking for a little bit more bearish tilt in the marketplace. Okay, the duration positions are rather advantageous. Now, duration kind of denotes wanting to hold that position in excess of 3 months. I'm going to be hunting for duration positions. Again, Costco happens to be kind of one just key example in here. Well, from Costco, we're going to move right over to what is termed the XHB. The XHB. Here's another duration position. So why am I actually over at the XHB? Well, here again, we were actually up when we initiated this duration position, just close to 20% on a year-to-date basis. Okay, we're looking for, it's the home builders, right? The home builders, which were getting absolutely decimated throughout the course of last year. And again, I think it's worthwhile bringing up a little bit of a longer duration chart over here, have not only come back, they've come roaring back. So this is, again, when I start to, discuss like risk assets going kind of awry. In this particular case, you're looking at like the home builders. It's almost spellbinding again and head shaking how fast and how vicious this move has been to the upside. Nevertheless, although I think this is going to take some time to play out, this is a duration short position that I currently have on. Okay, I am right now in the April options. We're ready to roll those April options. Those are deep in the money 42 puts. What do I use deep in the money? It's a synthetic short position. So as you start to assess some of the products that I've discussed kind of in this weekend's video for yourself, and you absolutely should kind of dissect some of the products, of course, before ever executing into any trades, you're going to see exactly what I mean. Okay, where it doesn't matter for no rhyme, for no reason. We are tossing, okay, risk to the wind. And that's why, again, I kind of dubbed this this weekend's update here, risk assets gone awry. Last but definitely not least, TheoTrade.com/live. This is the link to the Volatility Strikes Back live event right here in Scottsdale, Arizona, May 30th through June 1st. Early bird pricing is available, although ends March 31st. Okay, our early bird pricing is $997 for the entire event. It ends, again, March 31st. The link to this, TheoTrade.com/live. I want to thank everybody for joining us here at TheoTrade on this weekend's update. Have a wonderful weekend. Bye-bye.